Hello everyone, welcome to the market opening bell for Friday, May 9th. The Hang Seng Index opened 102 points lower on Thursday, but later rose, peaking at 22,979 with a gain of 287 points. It closed up 84 points or 0.4% at 22,775, marking 6 consecutive days of gains. The Hang Seng China Enterprises Index rose 58 points or 0.7% to 8,300, while the Hang Seng Tech Index gained 28 points or 0.6% to 5,228. Total market turnover was 185.8 billion Hong Kong dollars. Southbound funds recorded a net sell-off of 2.385 billion Hong Kong dollars in Hong Kong stocks, with notable trades including a net buy of $873 million in China Construction Bank and net sell-offs of $1.18 billion in Tencent Holdings, $878 million in PopMart, $841 million in Xiaomi Group, $710 million in Checker Fund, $697 million in SMIC, and $134 million in Li Auto. Data shows southbound funds have net bought Meituan for 9 consecutive days, $8.736 billion total. China Construction Bank for 4 days, $2.586 billion total. While net selling SMIC, $1.555 billion, Tencent to $4.325 billion, and Xiaomi $3.358 billion for 3 days each. Technical analysis, the Hang Seng Index hit the high of 22,979, but faced resistance at 23,000. It briefly surpassed the 50-day moving average at 22,803, but closed below it, about 200 points off its high, indicating significant selling pressure near 23,000. The index likely peaked short-term on Wednesday unless it can hold above the 50-day line and 23,000. Support levels are at 22,200 and 21,700. The 3 major Asia indexes opened lower but closed higher. The Shanghai Composite Index rose 10 points or 0.3% to 3,352, while the Shenzhen Component Index gained 93 points or 0.9% to 10,197. Total turnover in Shanghai and Shenzhen was 1.2933 trillion yuan, down 175.5 billion yuan from the previous day. The renminbi US dollar central parity rate was 7.2073, down 68 points. Back to Hong Kong, SMIC and Hua Hong Semiconductor announced Q1 results after Thursday's close. SMIC reported sales of 2.247 billion US dollars, up 28.4% year-on-year and 1.8% quarter-on-quarter, with net profit of 188 million US dollars, up 161.9% year-on-year and 74.8% quarter-on-quarter. Earnings per share was 0.02 US dollars, with a gross margin of 22.5% versus 13.7% last year and 22.6% last quarter. However, SMIC expects Q2 revenue to decline 4% to 6% and gross margin to range between 18% to 20%. Hua Hong reported Q1 sales of 540.9 million US dollars, up 17.6% year-on-year and 0.3% quarter-on-quarter, with a gross margin of 9.2%, up 2.8 points year-on-year, but down 2.2 points quarter-on-quarter. Net profit was 3.8 million US dollars, down significantly from 31.8 million US dollars last year. Q2 sales are projected at 550 to 570 million US dollars, with a gross margin of 7 to 9%. Both companies expect Q2 margin pressure, compounded by market hopes for relaxed US AI chip export restrictions impacting domestic chip makers. Geely rose 4.4% amid plans to privatize Zeekr. Geely proposed a non-binding offer to acquire all outstanding Seeker shares it doesn't own for $2.57 per share, or $25.66 per ADS, totaling $2.2 billion, valuing Seeker at $6.4 billion. This would delist Seeker from the New York Stock Exchange, making it a wholly owned Geely subsidiary. Seeker, listed in May 2024, has fallen around 20% this year, with a current market cap of $5.7 billion, below Neil's $8.8 billion. The privatization addresses Seeker's undervaluation, U.S. regulatory risks, and trade tensions, while avoiding pointless internal competition. It integrates Seeker with Link & Co., 51% acquired in November 2024, into a unified premium EV brand group, boosting competitiveness. Li Auto gained 5% after launching refreshed L-series models L9, L8, L7, L6 at an 8 p.m. event. The L6 unveiled at the Shanghai Auto Show is priced at 249,800 yuan and 279,800 yuan for its two variants, with orders open and delivery starting next week. U.S. stock market update. Trump announced a breakthrough trade deal with the UK, expanding market access for U.S. imports, boosting U.S. stocks. The Dow surged up to 659 points, hitting 41,773. The S&P 500 rose 1.6% to 5,720, and the Nasdaq climbed 2% to 18,096. The US dollar index also gained up 1.2% to 100.76, reclaiming the 100 level. However, late in the session, Bloomberg reported Trump is pushing lawmakers to raise taxes on some of the wealthiest Americans to offset other tax cuts, proposing a new 39.6% tax rate for individuals earning at least 2.5 million US dollars or couples with 5 million US dollars in joint income, compared to the current top rate of 37%. This news sharply reduced gains, with the Dow closing up 254 points at 41,368, the S&P 500 up 0.6% at 5,663, and the Nasdaq up 1.1% at 17,928. The Golden Dragon China Index, reflecting Chinese concept stocks, rose 68 points or 0.97% to 7,099. Alphabet stated Google's search traffic continues to grow, refuting reports of Safari under loss, with its stock up nearly 2%. Tesla rose 3.1%, Amazon and Microsoft gained over 1%, while Apple, Meta and Nvidia rose less than 1%. The UK agreed to a $10 billion Boeing aircraft purchase deal, lifting Boeing's stock 3.3%. Sources reveal Trump will sign an executive order next week to significantly lower prices of certain drugs through government action, pressuring most pharmaceutical stocks. Trump proposed a similar plan in 2018, but it faced strong opposition from the pharmaceutical industry and lacked support. On economic data for the week ending May 3rd, U.S. initial jobless claims fell by 13,000 to 228,000, slightly below the expected 230,000, down from a 2-month high the prior week. The Q1 on-farm business sector unit labor cost rose 5.7%, exceeding the expected 5.1%, a sharp acceleration from the revised 2% in the prior quarter, marking the largest increase since Q3 2022 to 7.4%, driven by a 4.8% rise in hourly wages and a 0.8% drop in productivity. March wholesale inventories grew 0.4% month-on-month, below the preliminary 0.5% estimate. The New York Fed reported April consumer inflation expectations for the next year remained at 3.6%, consistent with March and a 2023 high. Three-year inflation expectations rose to 3.2%, the highest since July 2022, while five-year expectations fell 0.2 points to 2.7%. Our stock pick today is China XLX Fertilizer, stock code 1866. China XLX Fertilizer actively responds to industry cycles and aligns with China's agricultural development trends. It has not only innovated its two majors, one share joint service marketing model to enhance brand recognition and market share, but also successfully completed key projects. For Xinjiang-based 60,000 ton per year polyformaldehyde project and the Guangxi-based 300,000 ton per year compound fertilizer project were both commissioned by the end of last year, laying a foundation for exploring new markets and sectors. Currently, the group's ongoing projects are progressing smoothly, including the Jiangxi Industrial Chain Extension Project, the Zhendong Project, and the Guangxi Major Project, all advancing as planned. Upon completion, total production capacity is expected to exceed 10 million tons. The group adheres to a fertilizer-focused strategy, leveraging its core business strengths to achieve synergistic development across segments. In 2024, revenue composition was as follows: fertilizer segment 58%, chemical segment 37%, pharmaceutical intermediates 2%, and others 3%. The group's urea production capacity continues to expand, with output rising 21% year-on-year last year, driving sales growth. Meanwhile, under stricter environmental policies, industrial demand has significantly increased, providing strong support for urea volume growth. For compound fertilizers, relatively loose raw material supplies and declining prices for key inputs like phosphate and potash fertilizers have reduced production costs. Additionally, the group's focus on high-margin products has effectively improved overall gross margins. In methanol, as China's economy recovers, downstream manufacturing sectors such as automotive and electronics have increased demand for basic chemicals, boosting the group's methanol sales. Supply-demand mismatches and falling coal prices have lowered procurement costs, while the group's continuous optimization of production technology and reduced steam consumption through R&D have significantly cut methanol production costs. For urea solution for vehicle, stricter environmental policies and advancements in new energy technologies have led to a declining fleet of diesel-heavy trucks, coupled with a persistently weak domestic economy and reduced transport of bulk goods. Demand for large diesel vehicles has decreased. To mitigate profit margin pressure, the group proactively reduced production, using flexible adjustments to maximize overall profitability. Melamine has been impacted by the ongoing adjustment cycle in China's real estate sector, with insufficient operating rates in downstream industries like panels and impregnation, and demand recovery falling short of expectations. In recent years, the group has intensified overseas business development, strengthening ties with existing international orders, which has effectively boosted sales volumes. TMF, a key chemical raw material widely used in slurry pharmaceuticals and films, has seen significant demand growth as China's industrial structure continues to optimize. The group has promoted equipment upgrades and technological innovations, extending production cycles and increasing output. For liquid ammonia, the successful commissioning of a 700,000-ton urea production facility at the Xinjiang base has further reduced costs and enhanced efficiency, allowing self-produced liquid ammonia to be fully converted to meet downstream urea production needs. In pharmaceutical intermediates, the group has further optimized its product structure, concentrating resources on nucleoside products. Recommendation: buy at 4.4 Hong Kong dollars with an initial target of $4.75 and a secondary target of $4.95. Stop loss at $4.2. I do not hold the above stock.